Before you even think about buying a home, there's one number that can make or break your mortgage approval, and that's your debt to income ratio. And trust me, most home buyers don't realize how important it is until it's too late. But don't worry, because my name is Kay, giving you the keys to home ownership. And in today's video, I'm going to break down how to calculate your DTI and explain to you what that number means. Let's get into it. First off, I touched on this topic a lot in my last video, but I didn't go into depth about what it is and why it's so important. So let me show you. The first thing to understand when it comes to debt to income ratios is what it is, what it means, why is it used, right? So your debt to income ratios, they're just percentages that show how much of your monthly income is going towards paying your debts, okay? And this is important because lenders use this number to really see how much mortgage you can afford. But it's really more important for yourself because when you're going to look for houses, you can truly assess what your financial limits are. And all that is how much home you can afford so that you don't over leverage yourself and regret your decision. Something that you should know when it comes to debt to income ratios are there are two numbers. You have the front end ratio or the front end percentage, then you have the back end ratio or the back end percentage. Okay, now the front end ratio just tells you how much house payment you can handle. Your mortgage payment, which is your PITI payment or your principal, interest, taxes, and insurance, should not exceed this percentage. And as you can see on the screen, I have an example of 31% over 45%. 31%, which is the first number shown, would be your front end ratio. Now, how to calculate this? All you're going to do is take your monthly housing expense, which is just a fancy way of saying your rent or whatever you're paying to live in your current situation. You're going to divide that by your gross monthly income, which is just the income that you make before taxes are taken out. And then you're going to multiply it by 100 to take it from decimal form and put it into whole number form and give you that ratio. For FHA, this number shouldn't exceed 31%, but I don't want you to focus too much on that because each loan type's ratios are different and they're different for each person's situation as well. Front end ratios, like I said, help you determine the maximum housing expense that you can handle. It's made up of your principal and interest, which is your monthly mortgage payment. That's fixed. That doesn't change. I went over this in my last video if you'd like to go back and reference that and go into some more depth on what these topics mean. So you have principal and interest. Your taxes and your insurance, they're not fixed. They can change every year. They go with the ebb and the flow of the market, things like that. Now, I know speaking here in San Antonio, Texas, we see it a lot. A lot of our neighborhoods are in HOAs or homeowners associations, and they have annual fees as well. You add all of these components or all of these parts up, and that will make up your housing payment. With a $5,000 monthly income and you have a maximum front end DTI of 31%, that would be $1,550. So your principal and interest, taxes and insurance, and any other HOA fees or monthly fees that may occur when buying that home should not exceed $1,550 to remain at that 31% if you make $5,000 in monthly income. That's how those percentages or numbers work out in dollar amounts. Moving on, you have the front end ratio, then you have the back end ratio. Now, the back end ratio just compares your total debt to your income. So in my example here, as I stated above, the 31% is your front end percentage, and then the 45% is your back end percentage. Both of those numbers make up your total debt to income ratio. Your back end deals with your housing and other debts. So for instance, right now, if you're paying rent, it would be your rent payment plus all of your other minimum monthly obligations, which I'm going to go into detail here in a minute. So the formula to calculate this is you would take your total monthly debt, which is your housing and other debts, divide that by your gross monthly income, multiply by 100, and for FHA loan, the threshold's anywhere from 45 and it can go up to 55%. These numbers are for qualification purposes when applying for a mortgage loan. That does not mean you have to, nor should you go up to 55% when it comes to the back end of your ratio, because this is saying that 55% of your income is going towards paying your total debt. So you only have, 35% left for emergencies, for savings, for other life things that are going to happen outside of your housing payment. When I say how much you really can afford, that's what I'm saying. You don't want to put yourself in a situation where you're over leveraged to where you're going to regret buying that house in the long run because we didn't do all this heavy lifting up front to see that you may not be able to afford what you bought. Now, your back-end ratio determines your total debt. Some areas that are included in this, majority of these are going to show up on your credit report. I'm going to go over some that will show up on your bank statements. And more recently, I've had the experience of having to add them to somebody's liabilities so we could account for this in their back-end ratio. So if you're someone who you currently own a home and you're wanting to use it as an investment property, a rental, or a second home, meaning you're going to keep the payment while also purchasing another property, you'd have to account for the monthly payment of your mortgage. There's car or auto loans, account for that payment. Minimum credit card payments, student loans, personal loans like payday or private or any other installment loans that may be showing on your credit report. Child support and alimony, that's one that comes up a lot. That'll even show up on your pay stubs if you're paying child support. We'll have to take your monthly obligation of that as well. Even your IRS tax bills or liabilities, this number does not show up on your credit report, but it does show the monies, or we can see the money coming out of your bank statements. And then some other ones that will show up on your bank statements, you have Affirm, Afterpay, Klarna, or anything else that may be similar to those accounts. Those are consumer accounts. Now, some things that your debt to income ratio will not include. It doesn't include utilities, groceries, auto or health insurance, any streaming or subscription services. And rent is not included in here either, or any other lifestyle fee. Lender does not account for these areas. And you don't have to, but if I was a first-time home buyer or just a home buyer in general, and I truly wanted to get a picture of where I stood in my financial situation, I would account for all of this: utilities, groceries, insurance, whatever. Because even though it's not being accounted for when getting approved for a mortgage loan, doesn't mean it's not still coming out of the account. With my example of using the $5,000 in monthly income, if your maximum total debt or your maximum back end ratio is at 45%, that would be $2,250 of your income going towards paying all of your debt. Now, we've discussed why DTIs are important, what makes up a DTI, what's included in the front end and the back end, what they're used for. Let me talk you through how to calculate your current DTI with where you stand at the moment. So the first thing you're going to do is add up all of your monthly debt payments. Look at your credit report, your bank statements, your pay, anywhere where a monthly obligation is being pulled from your income. Look at those statements, divide it by 12, find the monthly obligation, and then add all of those together for 1 month. Step 2 is you're going to determine your gross monthly income, which is just your income before taxes. So for my W-2 employees, if you're salaried, that should be easy. You just take your salary divided by 12, and it gives you your total monthly gross income. For anybody who's paid on an hourly wage, you can calculate this as well. You can even look at your W-2 from a previous year and use that number. And then for my self-employed folks, you're going to take whatever numbers you put on your tax returns, average them out over 2 years to get your monthly total income. When it comes to calculating income for mortgage loans, that can be difficult. So I'm going to do another video on that, but that's your second step. You're going to determine your gross monthly income. So now we have our debts, we have our income, The last thing to do is to calculate your ratios. And all you're going to do is divide your total debt by your income and then multiply it by 100. And that's going to determine your front end and your back end ratios so you can see where you currently stand in your living situation. I came up with an example for this. So our borrower has already done the work for us in calculating their monthly debts. They have $1,500 in monthly debt obligations. They have an annual salary of $60,000, and they currently pay $1,000 a month in rent. Now we got to calculate our gross monthly income. We're going to take that $60,000 salary divided by 12. That's going to give us $5,000 in her gross monthly income. That's the total. Then we're going to move on to calculating the ratio. In this instance, this person is already paying $1,000 a month in rent, so we're not going to use a proposed house payment. So we're going to take $1,000 and divide that into the $5,000 in income, multiply it by 100, and that's 30%. Meaning the rent that she's paying every month is taking up 30% of her income. To calculate the back end ratio, we're going to take the $1,500 in monthly debt plus the $1,000 she's paying in rent. You add them together. You're going to divide that into the $5,000, which is her gross monthly income, multiply it by 100, and that gives us 50%, which is her total monthly obligations, meaning that 50% of her income is going towards paying where she lives and the other bills to maintain her living situation and all the other debts that I talked about. This is important because just because you can go higher on some loan types with the DTI doesn't mean you should, because those numbers are telling you how much of your income you're currently spending and then how much you have left over. All of your income should not be going towards your house or where you live. You do need some reserve for life in general. Now, maximum DTIs for loans, these vary depending on everybody's situation, but just a generalization. For conventional loans, the back end ratio can go anywhere from 45 to 50%. For FHA, anywhere from 50 to 55%. VA loans, it may go above 50% depending on what your situation or the person is. And USDA loans, they're one of the more stricter loan types, so you can only go up to 41% for your debt to income ratio. I know I've talked a lot about ratios and percentages, but who cares about that? Okay, I know any buyer just wants to know how much can I pay or handle in a monthly payment, and how much house can I go shop for, meaning what's the purchase price I need to stay within. So there's something called payment shock that lenders use. And all this means is what's the difference between what you're currently paying and what your proposed housing payment would be. And those two numbers should not exceed 150% of each other. To figure that out, all you would do is take what you're currently paying. So in this example, $1,000, you're going to divide it by 2. That gives you $500. You're going to take that number and add it to your current rent. So 1,000 plus 500 is $1,500. That would be this person's maximum housing payment, aka their front ratio. And the available increase from their rent to their proposed mortgage payment would be $500. That's to figure out how much of a monthly mortgage payment you can handle. It should not exceed that amount, but you can go anywhere from $1,500 to $0. Anywhere in between, you should be good to go. To estimate a maximum purchase price, all you would do is take 3 times what your annual income is. So we said this person was making $60,000. All we do is take that times 3. That gives us $180,000. And that would be the maximum or estimated maximum purchase price that someone could go purchase a house for. Overall, just know this. Your debt to income ratio is important for lenders and for yourself. Your front end ratio limits your housing expense. And all that means is it ensures that you don't overspend on just the cost of buying a home or the cost of living in a home. Your back ratio controls your total debt. It lets you see the complete picture of your financial situation as a whole. I've showed you how to calculate your maximum purchase price so that you know your true budget when you're going to shop for a home. Even though you've been approved for a number, doesn't mean you have to go there. Lastly, as always, seek professional guidance. And if you do all of this upfront, you'll be more than ready to go talk to and partner with a lender that you know is right for you and your family and your situation to get you into your desired goal, which is owning that home. And boom, just like that. Now you know how to calculate your debt to income ratio and understand why it's so important for getting approved for a mortgage. And more so, why it's so important for you to know that for yourself. If you found this helpful, be sure to hit that subscribe button for more home buying tips. And if you think you're ready to start your home buying journey, check out this video here. See you in the next one.